Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is August 10th, 2026. My name is Jonathan Liang, and today I wanted to discuss last Friday's U.S. jobs report and what it might mean for Fed policy. Last Friday's U.S. non-farm payrolls surprised to the downside with a decline of 23,000 jobs in July, while May and June payroll gains were revised down to 63,000 and 20,000 respectively. Interestingly, despite the headline payroll number decline, the unemployment rate actually fell to 4.1% from 4.2% previously. The main cause of the decline in the unemployment rate, despite the worse than expected headline payroll number, comes down to the fact that the U.S. labor force actually shrunk by 264,000 in July. So while job gains have slowed from the second quarter of this year, labor markets remain somewhat imbalanced, with fewer workers looking for jobs and fewer jobs being created. So what does this mean for the Fed? We think on the margin, this non-farm payroll will give the Fed some extra room to keep rates on hold for longer, probably through the end of the year, as a strong job growth momentum we saw in the spring has slowed noticeably. The market certainly interpreted it this way on Friday, with stocks up, the Treasury curve bull steepening, and the US dollar index weakening further even post-yen intervention earlier. However, going forward, given Fed Chair Walsh's stated commitment to price stability, the upcoming inflation numbers will be very important in determining the Fed's policy path. Now, I happened to be in the US last week, and I did notice that regular grade gasoline prices in New Jersey have now dropped below $4 a gallon, meaningfully lower than when I visited earlier this summer. And this is true across the U.S. on average. The geopolitical situation in the Middle East remains a key risk, of course, but assuming we continue to move towards de-escalation, we think we may have seen peak inflation earlier this summer. Hence, we continue to expect no Fed rate hikes this year. With the 5 new task forces still busy with their analysis, as long as we do not get an unexpectedly hot inflation print, we think most Fed governors will likely stay patient and wait until the task forces present their findings before moving on rates. Futures markets are still pricing one rate hike before the end of the year, but if we are correct in our forecasts, then we think U.S. bond yields can moderate further, especially at the short to intermediate end of the curve, which is more sensitive to Fed policy actions. We recently brought our fixed income allocation to a neutral weight from underweight, while still being overweight equities. As we wrote in our latest weekly market view, we see room for equity market gains to extend, but would ensure portfolios avoid excessive regional or sector concentration. Thank you for listening, and I will speak to you again in future episodes of Cut to the Chase.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.